Before we hit the road on today's discussion, I want to express our sincere gratitude to our sponsors. Without their support, this podcast wouldn't be possible. So a big shout out and thank you to Performance Food Group, to C.H. Robinson, to the PepsiCo Foundation, and to the Knorr Brimps Global Cares Foundation. Without your support, this couldn't be possible. So buckle up and get ready for an insightful journey into all things next-gen trucking, your road to the future. Hey, welcome to NGT Talks. I am very excited to have Thom here today. I met Thom this summer in person, and he represents an amazing company called Reliance Partners. We at Next Gen Trucking have been partnered with us since the beginning. They are a founding member. Thom, thank you for joining us on NGT Talks today.
Well, it's great to be here, and I'm glad we were able to meet in person earlier this summer as well.
Yeah. So tell the audience, who is Reliance Partners?
Well, Reliance Partners is a company that's 15 and a half years old. We are the largest independent insurance agency solely focused upon transportation and logistics. So we don't do life, home, and auto, or we don't do property and casualty for, let's say, doctors' offices or restaurants. We live and breathe trucking and logistics. And so we've got a book of business, $50 million. That just means how much premiums through all of our various customers. We work with over 8,000 motor carriers and somewhere between 400 and 500 freight brokers. And a lot of our management team, both at the upper level and sprinkled throughout the company, worked in the world of freight at one point. So they may have been CSRs or account managers at trucking companies or salespeople at freight brokers or kind of all of the above. So we're sort of unique in that respect. And it's been a lot of fun to be a part of the company the last 4.5 years.
Yeah, that it is. I mean, you guys are on great growth, and I loved getting to see your founders, and they're pretty young, I felt like. So I love that, of course.
Yes. Andrew and Chad, Andrew, I think, is going to be 43 soon, and Chad's birthday is later this week. He'll be 43. So young guys, but a ton of business experience, a ton of wealth. Andrew actually founded the firm in February of 2009. Chad joined as our president in the fall of 2015. Yeah, either August or September of that year. So it's been a rocket ship. And then I joined in April of 2020, right in the heart of the pandemic.
Oh, wow. That's a great time to start. So, tell us about you. How did you get into this trucking space?
Well, I'm an accidental trucker, probably like 90% of the industry. So I really wanted to be in the investment world. I majored in finance in college, and I got on as a junior analyst at A.G. Edwards in 1988. I was hired by an industrial analyst. And so I was helping some senior analysts on their work around companies like the automakers, aerospace, John Deere, Case New Holland. It was just a litany of industrial companies, Illinois Tool Works. And then about a year into the job, they said, no one's doing transportation here. Technically, that's an industrial sector. And we would help you become a senior analyst if you do a lot of the groundwork. So some of my early work, more of my early work was with the railroads. Although back then there were just as many less than truckload carriers that were public. So, really got introduced to all of it. And over time, even equipment, the rail car makers, the tractor and trailer makers, the whole shebang. So it's been a great experience. I would say since about 94, I have no longer done the railroads, but really bet heavily on the trucking, intermodal, and equipment space. And ended up doing that until July of 2016 at a variety of investment firms / investment banks. And then the firm that I was at shut down our equity research department. And I knew that after 28 years that it was time to do something else. and did some consulting for a year, and then eventually became the CFO of a large truckload carrier.
Wow. And now with Reliance Partners. And one of the things I've really found fascinating about you and your story is how you dumb it down to a person like me. I go to a lot of trucking events, I listen to podcasts, and I hear people talk about the state of the economy and the state of freight. But your presentation was really, I mean, I could just understand it. And that's why I wanted to have you on Next Gen Talks today, so you could really help us kind of figure where we're at and where we're going. So I met you this summer in Nashville at the Trucking Matters Reliance Partners event, and
Yep.
it was awesome. I definitely want to go back next year. I learned a lot. There were a lot of great people there, and I don't think anybody should miss this conference. It was very well put together. But you gave that State of the Union talk, and it went into several different sections, right? We
Right.
talked about the state of the consumer,
Yep.
the state of freight, the capacity, and then a lot of other dynamics. So let's start with the state of freight. I want to hear, how would you describe what we're in right now, this overall freight market that we're in?
Well, we are in a very sluggish, mediocre freight market that really, even since the conference on June 5th, feels like it has lost some momentum. Some of the more recent numbers around the industrial aspects of the economy continue to slip just a little bit. Yet, when we look at it through the lens of history, the reality is that it's kind of a modest downturn. But in terms of what motor carriers and freight brokers are experiencing, it's probably the most painful of the last 8 cycles. And here's where I'm going to give credit to another individual, Professor Jason Miller at Michigan State, posts regularly on LinkedIn. And one of his freight data sources is a proprietary index that he and one of his colleagues created, their ton miles index. And they've looked at the last 8 downturns. That takes us back to OPEC in the mid 1970s. And the downturn that started, let's say, you could say the spot market started to turn down in March of 2022. Contract business started to turn down in June or July of that year, somewhere in there. So we're a little past the 2-year anniversary. It's really only the 5th worst downturn. And all 5 of those downturns that are, call it modest, they saw a 2 to 4% drop approximately in ton miles. Then there's 3 others that were whoppers that saw roughly 15 to 20% downturns. And so that included the OPEC oil crisis in the mid 70s, the great financial crisis or the housing crisis of about 15, 16 years ago, and then the interest rate crisis in the early 1980s. Those 3 were all significantly worse. But because this period was first dominated by freight was on steroids with all of the government stimulus back in 2020 and 2021. And so we borrowed from the future. And so we're still working off those excesses. We also saw an unprecedented buildup of capacity. And that's the singular reason why the environment has felt so lousy. And we're still not out of the woods yet. We're still working off the steroids, if you will. And the capacity has come down quite a bit, but we're still not quite at the point of equilibrium where supply and demand are balanced. So hopefully that wasn't too long-winded, but to answer where we are does require a revisit of history just a little bit.
Yeah, I think that's very helpful to look at the patterns of history. And, that's the state of freight. What about the state of the consumer? When I go to the grocery store, these prices are getting high and higher.
Well, and we have seen some inflation moderating, but the problem is that it went up and it's not going to come down in most cases. Now, some retailers and sometimes that's food and beverage as well as non-food and beverage, you're starting to see a few more discounts here and there, but not enough where it's across the board. So the consumer is struggling, frankly. And the first thing you have to look at with the consumer is what is happening with his or her purchasing power. And we know that after the inflationary periods of 21 and 22, where inflation was running up year over year, 6 to 9%, the majority of those 24 months. Well, we saw on average, the consumer lost a little over 9% of their purchasing power. But that can be a little bit misleading because that's a national average. And so where a lot of people live, maybe making $40 to $60, $70,000 a year, they probably lost purchasing power of 15 to 20% or more. So it's the consumer struggling. We've seen that not only manifest itself in some of the macroeconomic numbers and looking at purchasing power, but we've seen a significant drawdown in the savings rate. It has since 1970 averaged over 8% of monthly personal disposable income. We're down to less than 3.5%. We've seen an increase in 90-day delinquency payments on things like autos, credit cards, and even home mortgages. The default rate is almost 1% on home mortgages, and that tends to be the lowest delinquency rate, I should say. Default is a whole nother category, but folks always try to take care of their housing bills first and foremost because they don't want to lose that. And so we're seeing significant loss of momentum by the consumer here. And that's not to say it couldn't change some next year, but we're feeling the after effects of that.
Yeah. And with that being said, I mean, the housing market has had this huge boom. Where do you foresee that going in the next year or two?
Well, so it's been kind of odd. So housing starts and existing home sales have been in a slump for nearly 3 years. What hasn't really corrected are the prices of homes. So housing affordability is a significant national issue. One of the most important issues socioeconomically in this country, particularly for people under the ages of 35 or maybe even under 40, as they either look to get their first home or move up from that initial starter home. So we've seen really no correction in prices. We saw 2 years ago a stint 5 months in a row where the median home price came down, looked like we're going to have a correction. And then most months since then, it's been back up. So there's not enough homes being built on the new front. And interest rates, which I do believe will come down in 2025 and maybe start late this year, they don't need to come back to where they were 3 years ago. They just need to come back down 100 to maybe 150 basis points. And I think that's going to ignite the housing market, which also means more freight next year.
Yeah. So with that being said, the freight economy, do you expect any sectors of the economy that are experiencing growth right now or will in 2025?
Yes, I do look for housing to turn. And again, mentioned both the existing home sales. We're running a little over 4 million on an annualized basis. That's ironically the low level after the great financial crisis or the housing crisis of 08, 09. It never got below, I forgot if it was 4.1 or 4.3 million units. We're right around that level now. So we're bouncing at the bottom. It was interesting. Existing home sales went up a little bit after 2009 for the next few years, but they didn't really get healthy again until around 2015. So we're at the bottom. I do look for those to recover a little bit next year. We may see some portions of the ag and industrial sector see some recovery in the second half of next year. Aerospace has been kind of a good place this year, despite Boeing's headline risk. There's so many aspects of aircraft. And then, retail sales, it all kind of depends on what retailer you're looking at. We went through a stretch of over 20 months where the headline numbers, that you may have seen in the Wall Street Journal or CNBC or other sources, they were reporting up 0.3% from the prior month, not necessarily year over year, but sequentially. But many of those months were still below inflation. And so as inflation continues to move back towards 2% or better, we will see real or inflation adjusted sales begin to grow again in 2025. And we've seen, this year, some of the macro numbers, such as port numbers or the spot market, they've shown better absolute numbers than a year ago, but they're still below numbers people would like to see. And that, again, highlights where the problem with capacity as much as anything.
Yeah. So, one of the things that you talked about at the event was a deep dive of the state of capacity, looking back to the last 3 downturns.
Yes.
So what do these previous downturns tell us about our current downturn and where we're going to see ourselves in the future?
Yeah. If you go back to the industry discussions over let's say the last 12 to 15 months, there's been this big, what I call finger in the wind, people just kind of prognosticating, throwing out guesses. And it's not that any of us knows exactly when this recovery will begin, but lacking in the commentary has been an understanding of the 3 previous downturns. And lesson number 1 is that the correction lasted longer than the recovery in all cases. So that was kind of the mid 03 through mid 06 recovery. This was late 13 into the beginning of 15, and then kind of second half 17 into the end of 18. And listeners can certainly reach out and get a little bit more details. But in each of those cases, the correction or the downturn was about 20% longer as measured by number of months than the previous recovery. And so if we apply that 20% factor to what we went through, that would suggest we'd be around equilibrium around October of this year. Now, since I saw you in June, I did lay out a second scenario at our event. I said, well, what if it takes a little bit longer because freight was on steroids and all the aspects we've discussed? And I said, what if it's twice as long? It takes 40% or the correction's 40% longer. Well, that puts us into kind of February, March of next year. And given what's happening out there, I would probably lean more towards that. We did see a few green sprouts in June, and people got a little over excited in their commentary on LinkedIn, and other places. But at least we saw a few, and that at least says we're moving back towards semi-normal seasonality. And so that's at least a small positive. But I would lean towards being around equilibrium, probably mid to late Q1 of 25, just because of the general loss of momentum since our event on June 5th.
Yeah, that's so interesting that you say that. I have my meetings with our carrier members this year, and all of our other members, it's like, hey, yeah, we think that Q3, it's going to get better. And then it started to get Q4, and then it was hopefully 2025. So that's a good thing to hear that you're thinking equilibrium might start to happen in 2025, February, March. Really interesting too, is this week, I just got my transport topics, and the first page, when you open it up, talks about some increases, some profit soaring. Werner is saying that income is declining, but that Derek Leathers, CEO, is seeing hopeful signs. He was at your event.
Yes, he was.
And so when you talk to CEOs of companies, what are they saying? What are they seeing?
Well, July and August has been pretty sluggish, and that's pretty normal. But I think, again, many people got amped up because June saw those green sprouts. And so for your listeners, what do I mean by a green sprout? Well, there were occasionally some problems to cover loads. and not enough trucks in some mornings in certain parts of the country. And that we hadn't seen that in a while. There were some occasional equipment repositioning fees that CSRs at motor carriers or freight brokers were able to ask the shippers, hey, we're going to need a little more money to move that equipment in to cover your loads. And there was a little bit of movement in absolute spot market prices. But again, it was June. It's a big food and beverage season. It's kind of the making sure that items for outdoor purchases, patio furniture, sporting goods, things like that. A lot of that, of course, moves into the stores in March and April, but there's kind of one more restocking before summer ends, summer apparel. And then you start to see some of that go away in late July and early August as people gear up for fall. But we did see a little bit of improvement in vital signs. I think the real test will be probably closer to October, because over the last 20 years, the freight fall season, which used to kind of get underway in early to mid-August, it now tends to get underway more like in mid-October and really be more vibrant even into November up to about December 20th. That'll be the next level where if we use the 4-letter word busy again, even if it's kind of in quotation marks, I don't look for a whole lot of activity before then. But it's an interesting time for sure.
Yeah. And dare I ask about the election and how that might impact us?
Well, I try to keep politics out. I do kind of lean one way, but I'm going to give folks the benefit of the doubt on both sides of the aisle that they're Americans. We all want to move forward together. And I do think, it's easier to see that, one candidate might be a little bit more positive for freight creation, and the other's going to be a little bit more around some extra regulation and taxing and that. And, you mentioned dumbing it down at the beginning. You like the way I did that. Well, my lens is always about what does this piece of legislation, what does this development in trucking, what does whatever mean for freight creation? And I'm not an economist, but I think I'm pretty good at understanding human behavior and incentives. And, there are some things that are more incentivizing for American workers and American companies to go out and build and grow and develop and take some risk than other things, which put you more in a cautious hunker down mode. And I think for listeners, that's probably the lens that they should think about the politicians at all levels. Are they going to help unleash some animal spirits that would lead to a little bit better economic growth? Or is it going to be, we've just got to hunker down for another 2 to 4 years?
Yeah, I love that answer. Very, very diplomatic. So
I may run for mayor in my hometown someday. So that's a separate long-term story.
Hey, I like the sounds of that. So I think this is a positive conversation, because I really think it's going to help us to, that light is at the end of the tunnel, and we just have to keep moving forward. And I love the ATA, their new image campaign, nothing without trucking. And we know that if you look around the room, it's going to be mostly brought to you by a truck, right? So there really is nothing without trucking. So once you say equilibrium is going to happen, hopefully February, March, will the recovery be slow and sluggish or something else? How's that recovery going to look?
Yeah. And so a lot of times folks have been talking about, equilibrium. There's really two questions. Number one is the march back to equilibrium is slow, at times painful. And then once we've been at equilibrium for a quarter or two, I do believe that it will begin to be abrupt and fast. That's been the nature of the last decade or more. Data discovery is very big on both parties. So meaning the motor carrier side and the shipper side. So once there's a point where there's a consistent number of turn downs of loads, a certain level of equipment repositioning fees, you will begin to see things move fairly rapidly. It will begin to impact contract rates, spot market, the whole shebang. So I do believe abrupt and fast. But again, the march back to equilibrium is slow and painful. I wanted to give one more number, Lindsey. So in our analysis, we showed the growth in drivers back in June. Mm-hmm. And so pre-pandemic was just under 3 million drivers. And so folks who are listening may be like, well, what's he talking about? The BLS typically shows closer to 1.6 million, what is viewed as truckload drivers. But, we have partnered with a group to get a bigger sense of the driver base. So our analysis includes truckload, less than truckload, final mile using Class 7 and Class 8 tractors, and also private, what we used to call not for hire fleets, but many of which have gotten their own operating authority. So certain retailers and poultry companies that have large fleets on the road. So we saw that driver base go up over 700,000, or about 28%. We've seen that come down a little over 18%. We still have over 100,000 drivers more than we had pre-pandemic. I don't think the number has to go all the way back, because the U.S. economy is bigger, both inflation adjusted and on a real basis. So we're probably not as far away, but let's say, over the next 6 months, another 50 to 75,000 drivers leave the industry. And I'm not rooting for that on an individual level, but, just talking about capacity in general, that will help the industry get back to that equilibrium we are talking about.
Well, with what percentage of drivers are baby boomers, I'm sure we're going to continue to see a lot of retirements that happen, and that will really help that.
Well, and that's one of the things, trucking companies for 20 plus years have been talking about the difficulty of getting drivers. And sometimes there's a debate on whether there's truly a driver shortage or not. And I don't like to think so much black and white around that. I mean, I know companies truly struggle to get drivers, qualified drivers. There's a retention issue as well. They're both very real. But we do need to see more folks come into the industry, and over the long term, and the demographics are pretty doggone challenging. What I was going to say is that the one good thing about the pandemic, if there were any good things, is that the trucking voice about the difficulty of getting labor began to be felt and heard by virtually every industry in America. So we realize there's a long-term labor challenge in this country. Doesn't matter whether you're making widgets or moving freight or, doing podcast calls, whatever, there's a shortage.
Yeah. Mike Rowe says that today, for every four skilled people that are retiring, there's only one that's coming in to fill their place. So we definitely have to put a focus on skilled labor and career technical education in the trades. So I think that's a great point of where we need to go as a society. Does everybody need to go to college? Maybe not, right? Let's try to get some skills and career pathways laid out for these young people.
100%. Yeah, there's a shortage of plumbers, good HVAC workers, and also on the high end, there's a shortage of doctors. I mean, the things that I have to wait days for now, sometimes weeks, it's just crazy. It was not that way 15 years ago. I mean, certain types of doctors and specialists, and I mean, you can hardly get on their calendar in 90 to 100 days in some cases. You miss your teeth cleaning because you get the flu or whatever. You may not get your teeth cleaned for another 4 or 5 months.
Right. That's right. You better hope you don't have to miss those appointments. That's so true.
Yes.
So, as we kind of wrap up, you have some encouraging words, prepare to thrive, right? Can we look at a prepare to thrive freight economy? What do you think?
Oh, absolutely. So trucking has always baffled me, again, being around it since 1988 in one form or another. you could argue trucking has a lot of bad data, but one thing that they've got good data on is momentum. And so what I mean by that is when things are starting to get a little bit busier, they feel it. Or when things are starting to slow, if next week there's storms in half the country, then the tenders or the number of loads coming out from the retailers and CPG companies, they're going to be a little bit light. So truckers immediately feel that. They don't have a backlog to work off of the way a Boeing or a Caterpillar or a John Deere, Airbus, et cetera, have. They basically have visibility for about 7 to 10 days into their freight flows. So trucking has this data around momentum, and they don't do a very good job of being realistic with themselves. And so one of the smartest business people I know, several years, shared with me the 4 cycles of every industry. And it doesn't really matter where you start on these 4 sayings because you're going to repeat. But the prepare to thrive is a theme that I've been emphasizing. And that's going to be 6 to 9 months before a recovery begins. Whatever your industry is, you want to begin to prepare to thrive. And I'll come back to that in a moment. Then you actually go through a period of thriving. Then you prepare to endure, realizing that the good times aren't going to last forever. And then you endure, and then you rinse and repeat all over again. And so, for example, I began to have a very negative message in public speeches to the trucking community as early as February of 2022, a couple weeks before the Ukraine invasion. And I got more and more boisterous about that, very vocal, and in fact said at a few different events that it's going to be the worst downturn anyone's seen in their career. And yet people were like, we don't see it. We don't see this. And look, all the vital signs are coming under pressure right now. Well, fast forward to today, and truckers have been through some very difficult times. The amount of profit margin that's been lost is almost unprecedented, particularly at the healthy carriers. We've seen a lot of carriers fail. There's going to be a number of carriers that still fail over the next 4 to 6 months or so. And so it leaves people discouraged. But when you really look at a combination of the freight data and the macroeconomic data, there's been a bottoming. There's been an occasional vital sign of of encouragement. And so now is the time to think about preparing to thrive, because if I'm right and it does become abrupt and fast, then it'll happen so fast that companies won't have a chance to respond. So they need to understand what are their worst lanes now, what customers are better suited to be backhaul customers, and what lanes as opposed to head haul. What's their plan going to be from an equipment acquiring perspective if suddenly they need to grow their fleet 5 to 7%? What's their driver recruiting and retention plans going to be when it gets more difficult once again, as opposed to this relatively easy period? So no matter what your company's going through, even if your operating ratio is around 100, somebody needs to be in charge of the prepare to thrive game plan, so that if it does begin to happen in February and March, that you're not caught flat-footed.
I love that. I think that that's a great message to end on, because, we don't want to all be doom and gloom, right? There is hope, and it's right around the corner. And get prepared, have a plan in place, because it's going to get better.
100%. And this will be a supply-driven recovery.
Okay.
More than a demand-driven recovery. One of the candidates is talking more aggressively about tax cuts. That could be a real positive that would help consumers regain some purchasing power if they're paying a little bit less and they have a little bit more in after-tax income. But regardless, it's going to be supply-driven. Previous cycles occasionally saw some more fiscal stimulus, whether that was tax cuts or sometimes regulatory changes that cut capacity. Right now, we don't have that. The main fiscal stimulus that we can know about, regardless of who wins the election, is interest rates should be coming down next year, and that should help the mood of the company or country, particularly around durable goods purchases. So appliances, furniture, things tied to housing, electronics, etc.
Well, good. Well, I gained so much knowledge again from listening to you and what you have to say. And so thank you for keeping it simple for people like me. And so I can have kind of an insight into this. And I know that all of my members are going to love this, because that is the first thing we talk about in every conversation is, what does the state of freight look like for you today? And so this is going to be a good message for them to hear, that it is going to get better. So hold on tight. Thom, thank you for being on the show today. Thanks for what you do, and what Reliance Partner does, and how you help your customers thrive. So we appreciate you all, and thank you for being a founding member of Next Gen Trucking. Thanks for everything.
Well, thank you, Lindsey. It was great to be on your show, and Reliance Partners as an insurance agency appreciates the work that you and NGT are doing to open the eyes of young people to all of the career possibilities in the world of transportation and logistics.